criminal investigation into the sitting chair of the Federal Reserve. Not a rumour, not a leak, disclosed publicly. And if you think this is just about paperwork, cost overruns, or renovation budgets, you're missing what actually moves markets. Because when a central bank chair is put under criminal pressure, markets don't begin by asking who's guilty. Markets ask something colder. Is the central bank still independent? Or is it being forced to obey? For decades, Fed independence has been the invisible foundation under America's money system. You don't notice it when it works. You notice it when someone tries to crack it, when the institution starts behaving like it's afraid. And that's why this case matters. Because the fear isn't just legal exposure. The fear is policy exposure. Pressure for lower interest rates, timed for politics, not data. And once that suspicion forms, it doesn't politely wait for court dates. Jerome Powell disclosed he's facing a criminal investigation tied to the Fed's Washington headquarters renovation. But he also said something far more explosive. He believes this probe is really about monetary policy and the demand for lower rates. Wall Street Journal reporting and analysis describe a Justice Department move, criminal pressure that instantly turns a budget dispute into a constitutional stress test. Whether the case holds up or collapses, the signal has already been sent. If the Fed looks captured, inflation expectations can unanchor. If expectations move, bond yields move. If yields move, everything reprices. Mortgages, credit cards, corporate borrowing, even government interest costs. That's how a courtroom story becomes a kitchen table story. So the question isn't, is Powell right? The question is, what happens to an economy when the world doubts its central bank can say no? Especially when saying no is the entire point of having an independent central bank. The Fed isn't just an interest rate committee. It sets the price of money, backstops the banking system, and in crises becomes the emergency engine that keeps credit flowing. In modern economies, that's not a technical job. It's power. And it's structurally hard to control. Monetary decisions run through a committee that includes regional reserve bank presidents, not only Washington appointees. That design is intentional, because concentrated political control over money has a terrible historical record. Central bank independence exists for one brutal reason. Politicians love cheap money. Cheap money feels good now. More jobs, higher asset prices, easier borrowing. But it often creates inflation later. Independence is the institution's permission to disappoint you today. When elected officials can force rate cuts for short-term growth, they're basically rolling the dice with your purchasing power. The political payoff is immediate. The inflation bill arrives later, when the same politicians can blame someone else. There's an even darker concept, fiscal dominance. That's when government deficits become so politically untouchable that the central bank is pressured, directly or indirectly, to finance the state. The central bank stops leading and starts accommodating. Markets fear fiscal dominance because it turns the currency into a policy tool. Once money is used to solve political problems, inflation becomes a political strategy. And when investors smell that shift, they demand higher yields as protection. Economists call it time inconsistency, the temptation to stimulate today, even if it destroys credibility tomorrow. Independence is the guardrail. Without the guardrail, leaders rationalize short-term relief until credibility breaks, and then you lose both growth and stability. Because in modern finance, credibility is collateral. Lose it, and the cost of borrowing rises, not just for government, but for households and businesses. That's why global investors care about this story more than they care about your election calendar. Here's what's public in reporting. A criminal subpoena was issued, tied to questions about whether Powell deceived Congress during testimony connected to renovation cost overruns. That's not a policy disagreement, it's personal legal exposure. And personal legal exposure changes how institutions behave. Even if you're innocent, you start asking a different question. Which decision creates the least personal risk? That's how legal pressure becomes policy pressure, without ever mentioning a single basis point. A WSJ opinion analysis frames the renovation rationale as a pretext, arguing the real conflict is political anger about rate policy and public warnings about inflation pressures. Whether you agree or not, markets hear one thing: coercion is now in play. If the claim is even partially true, it signals something markets hate: policy by intimidation, not by evidence. Investors can tolerate tough decisions. They struggle to price decisions that are driven by fear, because fear doesn't follow a model. Outside the US, investors read this as institutional collision. The Times reports, investors rethinking exposure to the US, rattled by trade shocks and by attacks on the Federal Reserve that raise concern the bank's independence is under threat. That matters because global capital doesn't just watch inflation, it watches institutions. When institutions collide, Justice Department pressure, executive pressure, central bank resistance, risk premiums rise globally, and those premiums show up first in bonds, not headlines. Even if prosecutors eventually drop the case, the process alone can create a chilling effect. Leaders start asking, what decision keeps me safest? Not what decision is most correct. That's the real hazard. Precedent, not personality. This is the core risk. Not one chairperson, but a new mechanism, using criminal exposure as leverage over monetary policy. If it works once, it becomes a tool. If it fails, it still poisons trust. Either way, the institution pays. The WSJ opinion analysis says this didn't start with Powell. Before the subpoena, the administration tried to oust Fed Governor Lisa Cook on allegations of mortgage fraud, allegations she denies and which the analysis describes as difficult to prove. Legal framing says accountability. Market framing says power. Intimidate officials, distract them or push them out, then reshape the voting board. Central banking is committee math. If you can change who votes, you can change what happens. The analysis describes the play as intimidation into policy wishes, or at the extreme, pushing officials off the board so replacements can be nominated. That's not subtle. That's a blueprint for capture without passing a single monetary bill. This is chess, not checkers. Controlling the Fed doesn't require rewriting the Federal Reserve Act tomorrow. It requires making the decision makers fear consequences today. And fear is a faster policy lever than legislation. Why the legal route? Because direct removal is hard. The analysis notes legal and structural barriers, the Fed's complex design, and signals that courts may be unsympathetic to attempts to fire officials outright. And rate setting runs through a committee that includes regional Reserve Bank presidents, people not directly appointed by the White House. So if you can't control the structure, you pressure the humans operating inside it. Markets can price inflation. They can price deficits, but pricing institutional intimidation is harder, until it becomes the dominant variable. Then the market does what it always does. It charges you for uncertainty. When investors sense political interference, they demand compensation, higher yields, higher risk premiums, and less faith that policy remains anchored. That's how independence stops being philosophy and starts being a line item in bond pricing. If the Fed's credibility cracks, you feel it fast. Mortgage rates don't wait for a verdict. They move on expectations, on what bond investors believe will happen next. Independence isn't abstract. It's the difference between stable rates and constant repricing. Small businesses feel it too. When uncertainty rises, banks tighten. Credit gets expensive. Hiring slows. Expansion pauses. That's how an institutional story becomes a paycheck story. Quietly, steadily, and then all at once when defaults rise. And then there's inflation, the silent tax. If markets think rate cuts are politically forced, inflation expectations can rise before prices rise. People forget, inflation starts as psychology, then becomes math. A currency is trust with a symbol on it. The Fed is the trust engine. Undermine the engine, and the symbol weakens. And when trust weakens, foreigners demand more yield to hold your bonds, or they diversify away entirely. Pensions and retirement portfolios are built on rates. If bond markets reprice the US due to political risk, long-duration assets can get hit, month after month. It doesn't look like a crash. It looks like a slow leak. Banks rely on safe collateral and stable funding. When the macro narrative turns into institutional chaos, stress shows up where you least want it: liquidity. History shows liquidity crises don't announce themselves politely. They arrive on a Friday. Most people won't follow legal filings. They'll follow consequences: higher rates, higher prices, and the feeling nobody is steering. That's when confidence breaks. And when confidence breaks, spending and investment break with it. And that's why a probe over a building renovation becomes a global signal about boundaries of power. Central bank independence is a boundary. Once it's crossed, investors assume it can be crossed again, by anyone with leverage. The investigation doesn't just hit Powell, it complicates the next decision: who becomes the next Fed chair, and whether the Senate will confirm a perceived loyalist. The WSJ front page frames it as threatening to upend the replacement contest. Because confirmation isn't just politics, it's signalling. The wrong pick can raise suspicion that the Fed is being redesigned from the top down. and investors respond to signalling faster than they respond to economic data releases. The WSJ reports the decision remained between Kevin Warsh and Kevin Hassett, with insiders describing the frontrunner as changing depending on the day. That kind of process feels volatile, because it is volatile. That's not normal for the most important unelected job in US economic life. Markets read indecision at the top as future instability, and instability is expensive, because everyone starts charging a premium for uncertainty. The WSJ analysis notes Larry Kudlow saying the president wouldn't be able to confirm a Fed chair pick until the investigation is withdrawn. That is a stunning framing. Legal pressure as a gatekeeping tool for monetary leadership. If an investigation becomes a political prerequisite, independence isn't debated, it's negotiated. And once independence becomes negotiable, every future chair is vulnerable. That's why investors price this like a regime shift, not a personnel story. Powell's term ends in May. Deadlines turn institutional stress into a ticking clock, and clocks change incentives. The closer you get, the more tempting it becomes to force outcomes, legal, political, or procedural. When time gets short, behaviour gets ugly. People stop optimising for truth and start optimising for survival. And the bond market doesn't wait to see how that ends. It reacts to the incentives, because incentives predict outcomes. A key internal signal came from Philadelphia Fed President Anna Paulson. The WSJ reports she backed Powell amid pressure and said there was no hurry to cut rates again. That's a policy statement and an institutional boundary line. That message is simple. Policy is not for sale, and timing is not dictated by political anger. When independence is challenged, the Fed has to show unity, or markets assume someone is about to blink. Paulson described Powell's statement as strong and said it speaks for itself, while praising his leadership. In a pressure campaign, even basic support becomes strategic, because isolation is what coercion feeds on. The WSJ notes Powell became an unlikely folk hero, memes and all. That's not just internet noise. It's a social signal that people sense the institution is under siege, and they're picking a side, the side of credibility. Paulson stressed the Fed must ensure inflation returns to the 2% target. That is crucial, because when independence is questioned, the Fed has to over-communicate discipline. Markets fear easy money dressed up as compassion. The mandate is dual, but credibility is singular. If markets believe the Fed will trade away price stability for political convenience, inflation expectations rise, and that's when even strong labour markets start breaking under higher long-term rates. This story is bigger than Powell, and Paulson's comments implicitly point to that. Continuity is the battlefield. Once continuity breaks, every future chair looks temporary. And when policy leadership looks temporary, forward guidance stops working. Central banks run on norms as much as statutes. If norms get shredded, you don't get a neat replacement. You get permanent suspicion, where every decision is treated as political, and every pause is treated as fear. Here's the uncomfortable truth. Independence is not immunity. A central bank can be independent and still make mistakes, big ones. You can argue about the Fed's decisions without arguing for intimidation. But the question today isn't whether the Fed is perfect, it's whether pressure tactics are the right accountability mechanism. Because once oversight becomes coercion, you don't get better policy. You get policy optimised to avoid punishment. The WSJ opinion analysis warns that weaponising the law can short-circuit a serious debate about reform, turning structural questions into a political brawl. The result is predictable. Camps form, nuance dies, and trust bleeds out. Because once the fight becomes prosecution versus protection, reasonable reforms get buried. Everyone circles wagons. The institution becomes harder, not easier, to improve. And that's how you end up with the worst outcome. No reform and no credibility. The analysis includes a market warning. Investors can express discomfort with political lawfare in the bond market. Bonds are the fastest referendum on institutional stability. They don't vote every 4 years. They vote every second. You can argue ideology. You can argue intentions. You can't argue pricing. If investors smell coercion, they charge more to lend. And higher yields don't punish politicians first. They punish households first. If Congress wants oversight, there are hearings, audits, reforms, statutes. If the executive wants influence, there are appointments and persuasion. Criminal leverage is the nuclear option, and it changes the character of governance, because once the precedent exists, it doesn't disappear when the current president leaves. It becomes a tool the next one can use, against any chair, in any cycle, for any reason that can be framed as accountability. Stage 1 is testing, rhetorical attacks, public demands, and constant hints that the central bank should help the administration. Nothing breaks yet. The goal is normalisation, making interference feel ordinary, making resistance look unreasonable. In this stage, the market shrugs. Investors assume it's talk, but talk changes expectations, and expectations are the seed of repricing. The early stage is about setting the cultural conditions for the next stage. Stage 2 is coercion, investigations, subpoenas, personal legal risk. The message is simple: disagree and your life gets complicated. The WSJ describes exactly this kind of lawfare dynamic around the Fed fight. Even if a case fails, intimidation can succeed because it changes incentives inside the room, and incentives are what produce decisions. When leaders feel hunted, they stop optimising for the mandate and start optimising for safety. Stage 3 is personnel reshaping. Officials step down, get sidelined, or are weakened enough that replacements become politically easier. On paper, independence remains. In practice, the vote count changes, and that changes everything. Capture is rarely announced, it's assembled, and committees are vulnerable because you don't need to control everyone. You just need enough votes, enough fear, and enough uncertainty to shift the median decision maker. Stage 4 is policy distortion, rate cuts or stimulus that arrive not because the data demands it, but because politics demands it. The mandate becomes a justification instead of a constraint, and once that happens, inflation risk rises structurally. This is when the bill comes due: inflation risk, currency risk, and a higher political premium priced into everything. Even if inflation doesn't spike immediately, investors start demanding protection because they stop trusting the process. Stage 5 is the credibility break. Investors stop believing forward guidance, stop trusting the mandate, and demand higher returns to hold the currency and longer-term debt. Once the break happens, policy tools become weaker at the worst moment, and once capital starts moving, it rarely moves slowly. Credibility collapses faster than it's built. Rebuilding takes years. That's why the early stages matter, because by stage 5, you're not preventing damage anymore. You're managing consequences. Start with the US itself. In the early 1970s, political pressure for easier money collided with a fragile economy. The lesson isn't about one villain. It's about what happens when monetary policy becomes a tool for short-term political comfort. When independence weakens, inflation psychology shifts. People stop believing promises. They front-run price increases. They demand higher wages. Businesses raise prices defensively. The spiral isn't just economic, it's social, because trust has been broken. Now Turkey. The modern pattern is brutally clear. Repeated political demands for lower rates, repeated leadership changes, and repeated pressure on central bank credibility. The moment markets believe policy is forced, the currency becomes a scoreboard of confidence. And currency weakness doesn't stay on trading screens. It shows up in import costs, fuel, food, and rent. When the central bank's credibility becomes negotiable, the public ends up paying the price daily, not in theory. Argentina shows the endgame when fiscal pressure dominates monetary reality. When the state can't, or won't, fix deficits, the temptation is to use the central bank as a financing arm. That's when inflation stops being a cycle and becomes a regime. The result is predictable: chronic inflation, currency crises, capital controls, and a population that learns to distrust money itself. People flee into dollars, assets, barter, anything that feels more stable than policy promises. Different countries, same mechanism. Political impatience meets monetary constraints. Pressure rises, independence weakens, credibility degrades, investors demand a premium, currency weakens, inflation rises. Then, policy becomes even more political, because the crisis is now existential. This isn't saying America becomes Turkey or Argentina tomorrow. Pattern recognition isn't prediction, it's risk management. And when you see a system testing the boundary between law enforcement power and monetary authority, the warning is that boundary matters. Scenario 1. The probe ends cleanly. No charges, no forced resignations, and the Fed reasserts independence with stronger norms. This is the best case institutional outcome. But even in this best case, the scar remains. Markets remember the attempt. And scars change behavior. Future chairs may act more defensively. Future administrations may try again, smarter. The question becomes, do institutions reinforce the boundary, or do they quietly accept that pressure is now part of the job? Scenario 2. No dramatic takeover, just a chilling effect. Communication becomes softer. Officials become more cautious. Policy shifts just enough to reduce conflict. This is how independence erodes in real life, not with a revolution, but with concessions that become expectations. This scenario is dangerous because it looks reasonable. Everyone can pretend nothing happened. But markets don't forget incentives. If investors believe policy can be pushed, they price that risk permanently into longer-term yields. Scenario 3. Escalation. The investigation becomes a political battlefield, confirmation becomes war, and the Fed becomes the arena. In that world, the bond market becomes the referee, and referees can be brutal when they think the rules are changing. If investors see capture risk, they impose discipline through higher yields and tighter financial conditions. That's the irony. Political pressure for lower rates can produce higher long-term rates, because the market demands compensation for governance risk. All three scenarios share one endpoint: a higher institutional risk premium. Even if the economy stays strong, the price of uncertainty rises. Credibility is an asset. Damage it, and the discount rate on everything goes up. And the tragedy is this: central bank independence isn't ideology, it's economic infrastructure. Once it's damaged, rebuilding takes years. Investors don't accept "trust us" again quickly. They demand proof, consistency, and time. First, watch the language. If Fed messaging shifts from discipline to politically convenient optimism, that's a signal, not a style change. Markets read adjectives like numbers. When words soften under pressure, the institution may be adapting. A subtle tone shift can mean the Fed is managing politics, not just inflation. And once markets believe politics is part of the reaction function, forward guidance loses power. People stop listening to promises and start listening to incentives. Second, watch personnel. Confirmation battles are where independence is priced in public. A nominee viewed as a loyalist can trigger Senate resistance and market repricing. The WSJ notes the replacement contest is central, and now complicated by the probe. When insiders say the frontrunner changes depending on the day, that is volatility at the top. And volatility at the top leaks into credibility. When leadership selection looks political, investors assume policy will be political too. Third, watch the bond market. Bonds are the fastest referendum. If yields rise while inflation expectations rise, that can be the market demanding compensation for political risk, because investors fear the central bank won't be allowed to do what's necessary. You can argue policy, you can argue ideology, but you can't argue pricing. Investors will charge what they believe the risk is, and when the risk is governance itself, the charge can be stubborn and long-lasting. I'm not telling you to panic. I'm telling you to think like an institution. Watch incentives, watch constraints, and watch where power is applied. In governance conflicts, the mechanism is the message. Procedures reveal intent. A criminal investigation into a central bank chair isn't just a legal event. It's a governance signal. And governance signals become market signals. The story isn't the building. The story is whether the boundary still holds. Let's recap what's documented here. The WSJ reports Powell disclosed a criminal investigation related to the renovation of the Fed's Washington headquarters, and that he said it was really about monetary policy and the desire for lower interest rates. The WSJ also frames this conflict as lawfare around the Fed, describing a criminal subpoena and broader pressure dynamics, including earlier attempts to push out Fed Governor Lisa Cook, allegations she denies, and the analysis says are hard to prove. This isn't just about Powell. It's about whether monetary policy stays anchored to data or becomes a lever of political survival. If investors doubt independence, the risk premium rises. And when the risk premium rises, living standards get taxed through rates. In the next video, we'll map the early warning indicators, what bond markets typically do first, how currency pressure builds, and how institutional credibility can be rebuilt or permanently damaged after a boundary is tested in public. Disclaimer: this content is for educational and informational purposes only. It is not financial, investment, legal, or tax advice. Economic outcomes depend on many interacting factors, and institutional conflicts can evolve quickly and unpredictably over time. All claims here are based on the provided reporting and general economic reasoning. If you disagree, leave a comment with evidence, because in a credibility crisis, facts matter more than narratives, and mechanisms matter more than slogans.